Hello everyone, welcome to Just Invest Today. And today we're going to be talking about a famous value investor named Mohnish Pabrai. And he is a really good value investor. He follows the fundamentals of Warren Buffett. So anyone who follows Warren Buffett knows that you're going to get pretty good gains if you follow what he does and like the things that he does to make those good investments. So today I want to talk about two videos that I kind of went over to see like kind of what he does and how he invests, and two videos that talk about his investment strategies. And in these videos, it gives a bunch of tips on how to invest. So I kind of went over it and wrote some stuff down about these investments. So you can find a bunch of these videos on YouTube where he talks to college classes about his investment strategies and what he does, and they ask him a bunch of questions. And one of the things he talked about was focusing on the downside of your investment. I really think this is kind of an underrated concept. Not a lot of people like do it or even think about it as much as the upside. So what he does and what he thinks about is, what can the worst thing possible go wrong with this company? Which is a really good concept to have instead of thinking about, oh, all the upside potential of this investment. You think about the downside first and what could go wrong. And he thinks about that first. And when he thinks about it, he makes sure there's nothing crazy that can happen to this investment or to this business that will kind of get him off guard or like kind of phase him. And if he can't answer that, then he moves on to another business. But if he can answer it and he feels like there's nothing out of the ordinary, or there's a good answer that satisfies him and there's nothing that would go completely wrong with this business, then he looks forward and thinks he can invest into this company. When Mohnish Pabrai gets past that part of figuring out the downside of a business, he makes sure that these companies that he's about to invest in or thinking about kind of satisfy his criteria, which he kind of looks into before he makes an investment. So when he's making an investment, he thinks about the misunderstanding of the actual company's moat, which is actually very key. And you got to focus on this. If you misunderstand the moat of a company, it can actually have a huge downside to the business, which you really don't want, right? So you want to make sure this company is on top of its game. It's one of the best companies out there, and there's nothing that can like take it down. It has a very strong competitive advantage. Think about a company like Coca-Cola, where there's no company out there that can take down Coke. Like, everyone loves Coke, it's in everyone's mind. It's a huge brand, and when you think about pop, or you think about anything like that, you think about Coke. Like, there's nothing that would come into the market that would take it down. So you got to think about these companies that have a strong competitive advantage. The next thing he thinks about is over leveraged companies with a lot of debt. He avoids these companies because one misstep and all you know, the company goes into Chapter 11 bankruptcy, and then you're out of your position. So you really want to avoid companies with a lot of debt, which would kill you, especially if you're a beginning investor. Investing in companies with a lot of debt, a lot can go wrong, and you don't want to like have that huge downside and that potential of a loss. You don't want to invest like 10,000 and you lose it, and then your next investment, you don't even want to make investments anymore because you lost big on this investment. So try to avoid companies with a lot of debt. The next thing Mohnish talks about is the company's ethos. So how is the company's culture? Like, how do they treat customers? How do they like manage people? And that's a very important. It's like a tell-all sign about how the company's gonna like handle, how the company's gonna go into the future. Because we all know businesses depend on its customers. So give an example of like Apple. When you go to the store, like it feels like a happy place to be in. Like, everyone's there, everyone's moving around, everyone just all some service to you. Everyone's coming up to you saying hi. So you can tell already that like that's a positive company you kind of want to be around and just to see and be in. So you want to look for companies with good management that build a great culture, which is very key in your investments. So the last thing I guys want you to focus on is buying companies that are growing and not buying companies that are just very steady. Because buying companies that are growing is like the holy grail to investment. When you buy a company that's at like $10 or whatever the price is, and it goes to 20 to 30 to 40 to 50, that's what you want. You want to buy companies where you can buy it once and never think about it again. Like, we're in this game for the long term. So when you're buying companies, you kind of have to know where in the life cycle is this company. You don't want to buy a company like Coke, another example, that is at the end of its life cycle and it's not going to grow like crazy, maybe 4%, 3%. You want to own like a business maybe like Square, that it's just beginning and you can see it having a growth rate of like 20% like every quarter, which is amazing. Like, that's what you want, because when you can buy companies like that, you don't have to think about it. You don't have to keep looking at the stock. And everyone knows, I think I made a video about this, that you don't want to keep looking at the stock because it ruins your gains. You just want to focus on just one-time investment and leaving the company alone for life. That's what we want in our long-term investment strategies. And I want to talk about making the difference between a great investment and a great business. I think a lot of people kind of get that confused, and I think that's where a lot of people go wrong in the market. Just because everyone knows what a great business is. Everyone knows what a great business is when we look at one. Like, you can look at Apple, you can look at Facebook, Microsoft, all those great companies that we see. But just because it's a great business does not mean it's a great investment. Those are two completely different concepts that you have to kind of get down packed. When we make great investments, we usually are focusing on the value compared to the price of the stock or of the business. So if you're buying Apple at its all-time high, that's not a great investment, because the gains you're gonna make after that it's not gonna be as high as if you would have got it for 180 and then you kept seeing it grow and grow to its all-time high, instead of investing at its all-time high and thinking it's just gonna grow and grow. That's where you make big mistakes, because we're not looking at the downside. That you buying at an all-time high, that can tumble very quickly, and then you're out of luck. So we have, as investors, have to know the difference between a great business and a great investment. So that's a very strong advice by Mohnish Pabrai, which I took down to heart, and I really had to like think about that concept and kind of implement it in my head and think about it, so it sticks in there, because that's the thing I struggled with when I was kind of first starting out. So that's it to the video, guys. Please like and subscribe to this video, to my channel, and I'll see you in my next video. Bye.